Good turnaround Tuesday, everybody. Let's have a good day. Simon, how are you? Trade Journal, Ingmar. Who else is here? And Hugo's here too. Okay. And Ryan's around.
Morning, mate.
How are you, buddy?
I'm good, mate. You?
Good. I want to start off with what I'm seeing here in the 10-year. Okay. So here's the 10-year. Can you see it, Ryan?
Yeah, got it, mate.
Okay, all right. So you have one, you have two. I think we're going to make a move up towards 3%, maybe a little bit above it. Have some moving averages up here. So yields look higher to me. Yesterday I was talking about with Kman that I still thought the yen had some upside, that we could even clean out shorts over these levels, and dollars getting closer to, sell zone. I'm thinking up here around 107.20, some type of 61.8% fib.
Yeah.
And with that, precious metal. So I'm thinking basically the narrative is yields higher until 3%, and maybe that's the end of the dollar rally and a low in the metals. Just my guess here. And wondering.
Educated it is too.
Also, S&Ps on the 4-hour basis, kind of diverging up here. I think that if we got, this is really going to be important to get back here. But, everyone's talking about the 200 day here. I mean, we're almost there.
Yeah.
I thought maybe we might pull back before we break through it. So that's the way things look to me. Any big news overseas or anything we should be aware of that you guys talked about in the Flow show, which everyone should go to if they are in the U.S. and do crystal meth and are up all night? Huh? Huh, buddy?
Yeah, let's not advertise that factory.
So, especially the yen, what lit it up?
There's not been a lot really, but a bit of dollar strength across the board. The main thing, there's not been any huge news out. We've got a bit of softness in Germany again. With the zoo report, that was negative. They finally picked the number for their energy levies, so everyone's bills are going up in Germany in October by around about 13% on average. So you can forget peak inflation over there for a while.
Yeah.
Okay. Yeah, it's been a strange, because obviously we had a really sucky empire manufacturing in the US yesterday. Poor housing data. So you think, why would yields be higher? But it's this constant pull and push, isn't it, between what the Fed will do and what the market thinks the Fed should do. 1 minute we're looking at recessions, next minute the Fed are saying we're hiking away. It's like a seesaw, isn't it?
Yeah, I read something that Fed guy put out, something about that the Fed could do, replace certain things that are coming off the balance sheet with T-bills or something that actually adds liquidity to the market while they're letting some of the other stuff run off, and that they've done it before. His explanations are good, but I still don't understand Fed speak and all the technicalities of, buying this, selling that, and the impact of it. But I guess they have some tools to, keep some order in the treasury market.
But why are people still looking at how the Fed could ease while they're tightening? It seems people can't let go of the bone, can they?
No.
The Fed are on one of the strongest hike paths in their history, recent history, and people just keep looking at how they might ease. Go with what the Fed are doing. The Fed are hiking. Until they stop hiking, they're going to keep hiking.
Yeah.
Sounds like a corny thing to say, but everyone keeps looking at how they might not hike as tight as it's bonkers.
I mean, and if the markets are giving them or forcing their hand to tighten, because I mean, here we are at 4,300 in the S&P. So easier for the market to take tightening now than it was down here. So why would they stop and go ahead?
Stocks have done nothing but go up the last couple of months. I mean, I know Kay mentioned on the flow show we got OPEX this week, but you look at it since June, and stocks have been by the dip all the way. Even while some data comes in rubbish. I mean, as I said, housing and manufacturing might be looking a bit soft again this month, and stocks keep going higher. So it's either stocks are going higher because the US isn't as bad as everyone's expected, so investors are going to, put their money in the US, or the data's turning bad and everyone thinks QE's coming back and the Fed are going to do their twist. So buy stocks. It's like how many reasons can you buy? I think
their rationale is the inversion of yield curves. Might be one of the reasons that they think the Fed can't keep, keeping its foot on the brake. But, most guys talk about, it's nice crude came down and some food prices came down, commodities came down. But the one thing that the Fed wants to break is the tightness in the labor market. Yeah. And that's not happening. So I guess, they are probably sowing the seeds, whether we have a recession. We're in one now. We should be in one by next year when all this tightening filters through the system, especially if they keep worrying about labor tightness, market tightness.
I might have to do one of my MS Paint diagram specials because, as I said on the flow show, you need to put a tick box below every part of the economy. So jobs, manufacturing, services, employment. And, we see when the Fed ticks all of those boxes, i.e. they've stopped or lowered the demand in all those areas, that's when they stop tightening. And there's really only one box that's looking like it might get a tick at the moment, and that's the housing market. If prices start rolling, that's the nail in the coffin for that one. You can tick that box. But the Fed won't stop tightening until they've ticked every box. So they've slowed demand in employment. They see a slow demand in manufacturing, in jobs, the whole lot. So really, you want to guess about the Fed, wait until we see the data saying that now's the time to tick that box and the Fed have got their wish. Because that's when that's when they end rates. Simple as.
Yeah, that's a great idea, great visual to keep people straight about why they still have to move ahead.
Yeah.
And, I see that we have Steve is with us today, but I want to go to Kman, see if he has any input on US dollar yen.
Good morning, Dale.
Hi, how are you? Good afternoon, bro.
Yeah, I'm doing well. And I must say, this one has done its trip completely without me. I'm
news alert. Kman finally missed a move in the yen.
Yeah,
called the Guinness Book of Records.
Right down 16th of August 2022. Yeah, we are on a pretty important levels, though, in my opinion, around here. The 134.40 has always been like a stop or acceleration zone. I think one and all has to do with possibly the Japanese government lifting or not reinstating virus controls, and then, as I've been saying over the past couple of sessions, and even longer, is that the Japanese government is doing part of Kuroda's job in putting stimulus packages on. So we can't really, I can't really buy yen for a prolonged period of time. And then after, when the dollar came back versus the rest, dollar yen seems to me to have been a catch-up move on.
Because it did nothing yesterday. It did nothing yesterday with dollar strength, and today it's leading the dollar strength.
Yeah, I mean, it actually went lower on the New York Empire, and that seems to have taken out some short-term stops, and the other way around we went. Pretty impulsive move from that 132.5 on the dollar yen.
Okay.
I see on the Canadian dollar we have to.
We have some news there, right?
Canadian CPI coming out, in about 20 minutes. So that could be a decent mover.
This taking out this high which happened on a Friday. This was the NFP, I believe. taking out these highs would definitely shake shorts out that thought they had it going.
Yeah.
I remember Blake warning down in here late last week to be careful about being short Canada.
Yeah.
And that was, great trader intuition. So, okay, so
I
we'll
got
see
long down there.
Nice, man.
And
I
it
know.
was not my call. It was one of our chat room traders, Steph. She said she was, and I'm like, look, I wasn't even paying attention to it. But she pointed it out that it was carving out a low, and I went long. So,
right at the 200-day it held, man.
Yeah. It was a good placement. Anyway, I'll come back.
So okay. So metals following through a little bit here.
Yeah,
On
but
the
it's
downside.
Sideways action on gold mainly, and silver. It's really sideways. There's a few trend lines around here, and this 75, 77 zone. If it goes below, we can perhaps get back into the 17 and a halves. But then the bigger one, 1805 or 4 on gold has held. So I think we're in a little bit of a holding pattern right here and now, and see what happens on more data. Yeah, and then back on silver, I think it failed again up around 2085 figure, and now we're trying to come back a bit. I think that the China sluggish numbers and the New York Empire put silver on the defensive again compared to gold. I mean, we're still above $20, but it doesn't look extremely attractive for me to have a lot of silver position right now, apart from my long-term ones, which I'm keeping.
Yeah, I think we could get to the 50% retrace zone.
Yeah, we can get there.
So patience, I think, is, if you're precious metal bull, you have precious patience and
Exactly.
wait for your levels.
Uh-huh.
So Steve is here. Hi, Steve. You've had a great August and July. Nice summer, huh? I'm jealous.
Can't complain.
I mean, some of those spots you were at, it looked like you died and gone to heaven. You were in paradise. So, and everyone
Come visit,
happy.
and you can be in paradise as well.
All right. I mean, I'm an hour and a half away from it now. I used to live in paradise. Now I live in purgatory. Anyway, what are you thinking? Sometimes when you're away from the market, you come back and you have a fresher perspective.
Yeah, that can be the case on occasion. I agree with you.
But not with you. Could it be? You have a fresh perspective.
Listen, my point of view is never very short term. So, so I can't say I've seen many things change on the charts. Main highlights, in my opinion, in the week I was away, is the breakout in USD yen, which is breaking out from a corrective channel again, and the rejection of major USD pairs like the Euro USD, the cable. So it's, as I've been saying, I think it was too early to to call a DXY top, right? A dollar top. For the time being, the dollar remains resilient. And in my opinion, the only divergence I see here that is obvious is equities. So I think equities have started being really stretched here, and I think we are probably close to at least some kind of a pullback, if not something more than that, right? So I'm looking towards. We have on the S&P. We have the 61.8 of the move lower from the all-time highs coming through at 43.60 roughly. So I think that probably
look at that, Steve. 50 week, right near your number.
Yeah, it's the 50. It's the 50. Coincidentally, it's also the 200 DMA there. a little bit lower actually, not at 43.
Oh, yeah.
60, the 200 DMA is roughly at 43.20. So anywhere between like here and 43.65, roughly, I think it's very likely to see equities turn lower, and we take it from there. Now,
Okay.
having to do with...
Don't you think that the commodity currencies look much better than,
yes,
you know,
they do.
yeah.
That's why we still have the crosses, the Euro Aussie, Euro Kiwi,
Yeah.
Pound Aussie, Pound Kiwi. We talked about them last week again. The week before that, we have them still doing very well, having to do with the shorts, right? Those that have been short have been doing very well. Although, of course, if we do see equities roll over and risk sour, we should see a reversal there as well, at least temporarily. Right. Now, having to do with just a macro comment, having to do with what Ryan was saying before, having to do with the Fed wanting to put stop on demand and, you know, on froth on, you know,
housing,
several markets, etc. I couldn't disagree more, having to do with the labor market. I've explained that before. I agree on everything else. I couldn't disagree more with having to do with the labor market. We currently have inflation because people were actually not working and getting money. There is a huge misconception that tight labor markets, and I could also make a very elaborate argument how these
they're not
labor market is not even tight, but they're not inflationary. They're quite the opposite. They're deflationary, because people working actually help bring prices down. Now, the only argument in regards to that has been, and it's a very, very old Keynesian argument, that tight labor markets make employees, workers have, you know, a lot of negotiating power and push the price of products much higher because of them demanding, you know, especially in the past, there were labor unions that were strong, etc. When these theories were developed by, in essence, you know, demanding a lot higher pay, etc. Which, mathematically speaking, we know that's not the case, because wage increases have been trailing and not leading prices higher.
Okay, and you don't really believe there's a labor shortage. Is it because of the Great Resignation and just worker participation? It's just a choice.
And I remind you that we don't even count employment the same way that we used to, right, in the past. People that are outside the labor force for 1 year plus don't count at all as unemployed.
Ever again?
Right? They don't count as long as they don't find a job again and then become unemployed, and a period of 1 year passes, right? In which case they disappear again from the unemployed, you know, pool segment.
Can I throw a question at you, Steve?
Sorry?
Can I throw a question at you, mate, regarding employment and stuff? Do you think that inflation and all the price pressures and the cost of living stuff is getting people back into employment? So could we see strong employment purely from, let's say, people who had enough savings and quit after COVID?
Yes, that's always the case. In general, any weakness in people's financials push some part of the population back in the labor force. The problem being, though, is that in many cases it's people looking for part-time jobs or extra jobs, right? People that are already employed that look for extra jobs just to make ends meet, on one hand. And on the other hand, we also see another segment of the population in these cases coming back, usually people that have retired, like older people that, you know, they had a specific financial plan, they thought they would be just fine, but then inflation or other factors like a big, you know, recession or depression that erodes their income one way or the other, comes, and then, you know, they make the math again and they realize that, no, I don't have any more enough money to stay retired for the rest of my life. So they come back into the labor force. In many cases, this last segment of the population, unofficially, right? They work black. You know what I mean?
Yeah.
Oh, for cash, you mean?
Yes. Yes.
Yeah. I was wondering, I wanted to talk to you about that. Would the, 80,000 new IRS employees come on the new bill? What's it called? The inflation?
The Inflation Reduction Act, which of course is going to increase inflation as the vast majority of the government programs. Look at what is. Yeah, look what they were supposed to be making, and be more or less sure they're going to achieve the exact opposite result. Now, having to do with IRS agents, I hope everybody realizes that you don't need that many IRS agents to go after the super rich, right? For two reasons, and I've said that before. First of all, the very rich people do not tax evade, right? It's not in their favor. They tax avoid, which is a totally different thing. It's legal, right? So these people do not tax evade, they tax avoid. So, guess who, and the vast majority of the untaxed income, unfortunately, is in middle class. So guess who these IRS agents are coming for?
Right. Yeah.
Everybody and Dale. They're going for you, Dale.
Yeah, for sure. For me,
they're coming right after you, buddy.
Yeah, they're at my door right now. Hey guys, I'm doing a
IRS,
show,
and I hear they're going to be armed as well. So they're going to be.
Let me tell you what the ad for the new IRS agents says, that you have to be willing to carry a firearm. I just wanted to ask Steve one more question.
I qualify.
Okay. You could moonlight. And Steve, I saw yesterday that consumer credit is the second highest reading historically. Credit card debt.
The problem is that
the people that aren't going back to work are living off their cards again, aren't they?
Exactly. The problem is that the consumers are not going into credit because they're in a spending binge, very optimistic about their future income, so they're willing to go more into debt now because they're expecting more money in their pockets shortly to repay their credit cards. Unfortunately, they've been spending just to keep up with everyday costs. And as you know, there is always a ceiling in that, a limit, right? There is no unlimited credit lines for credit cards, etc.
Okay.
All right, guys. Hey, real quick, we got about 7 minutes till the Canadian inflation data. I wanted to talk a little bit about that. Steve, welcome back. I hope you had a great trip, by the way.
I did.
All right. Hey, and before I get into the Canadian dollar and looking at how we can make money following this Canadian data, I want to ask Ryan and Kman, anything on your radar? I know housing data just came out of Canada just moments ago. But any opinions that you guys have had? You guys have been in front of the screens a lot longer than me for the Flow Show. And by the way, if you don't know how to get to the Flow Show, if you guys are European traders and you're around in the markets, I don't know why you're not listening to this free show. So I'm going to go ahead and put the link in the chat box. So make sure you guys are all registered and so you join Ryan and Kman live every day. Hey guys, so any thoughts on Canada here going into this inflation print?
Hey Blake.
Hey, good morning.
I'm just a tad. It's really a small position, short EuroCAD for now because of the oil seems to hold, and I don't believe in longer term Canada weakness yet because they are beneficiary of the energy situation as well. And I'm actually waiting to see if we get a little spike up to mid 131s, perhaps on the EuroCAD to add a little bit to my position. So both and the euro, as people know, I still can't buy it. So that's what I'm looking at on the Canadian side. Dollar Canada, no real view right now.
Okay, so you're just looking for a little spike up to sell into. All right, Ryan, good morning.
Morning, Blake.
How are your ribs?
Yeah, all good, mate. All good.
Good,
Hanging
good,
up.
good. But what are your thoughts on Canadian data? I mean, we have inflation data coming out. Are we going to miss? Is today going to be like is it going to be like a swing and a miss, or what do you think? I mean, most people are expecting, the trim the trim, which is like they exclude 40% of the most, they call it the most volatile data. They're expecting that to come in a little lighter than previous print, but they're expecting their regular CPI or common CPI to move up a tick. So what do you think is going to happen here? I mean, U.S. is already starting to show signs of quote unquote a top in inflation. What do you think?
Yeah, everyone's looking for the peak inflation story,
Right.
aren't they? So really, you've got to go with the flow. If inflation misses, it's obviously going to take some of the steam out of, or possible steam out of, Bank of Canada hikes. So you're going to see obviously dollar CAD rising if inflation misses. But if it comes in strong, CAD should gain because it keeps the Bank of Canada on the path. So it's pretty much a binary event here. And all I'm doing, I've been watching this 129 area. It's a bit of a zone that we've been sitting in. We do seem to be on the oil bus at the moment as well. So in the wider picture, if you think that China is heading towards problems, we saw manufacturing from the Empire, terrible number yesterday. That's not good for oil. So if you want to take the oil side of things, keep an eye on that, because if oil starts weakening, that's a positive for dollar CAD.
Okay, and we were talking, this dollar CAD yesterday. We had a really nice move, and like I said, I was actually long here. This is for those of you that are not in the ForexAnalytix community, I'm going to just take you over to the trades room so you can kind of see what we do around here. Like, these are my current open positions right now in FX, but like let's see here. Now, remember, I was actually long the dollar Canadian, and it was not my trade. It was actually, I was in it from another one of our traders in our community, Steph. She had mentioned it, and I'm like, you know what? It looks really good. I actually ended up picking it up for 137 pips. You can see I closed out of a bunch of dollar positions yesterday. And then, I closed out of some of my euro short. But and then there's Kman, there's Ryan, there's DK. You can see there's a lot of us that this is just the trades room. That's not obviously the general chat room. The general chat room is where all the magic happens, and you see a lot of the chatting with everybody else. But you guys come join in the that community, because we all get trades from different people. It's not like, we get ideas from everybody else. And like I said, I wasn't even paying attention to that, but we had this nice inverted head and shoulder pattern. Looks very, how should I say it? Impulsive here. And it looks like we're building like a bull flag. So if we do get some weak data, Ryan, and like you said, it's going to be pretty binary. I mean, that move would take us right back up to the, 130.50 level, maybe even better than that. So really, I don't have any dollar Canadian positions right now, but I would be thinking, man, weak data is going to give us a great opportunity. I think you get if you get a decently weak print today, move back above 129.30, that's going to be bullish. I think you got to be, looking for some momentum longs, into later today. What else would strengthen the dollar today? Would also be weakness in the stock market. And Steve, you were talking about the 4,300 to 4,360 level. Yeah, I this is really big for the S&P. I mean, the S&P is right at the 200-day moving average. There's a 618 retracement here. There's the channel resistance. You can see the descending channel. Horizontal resistance is holding thus far. That's a quadruple confluence of like a lot of technical, resistance. On top of that, if you take this high right here in May to this low, that's 127% extension of the last leg lower move. A lot of resistance up here. So if the stock market is going to stall, it's going to stall somewhere around here. So if it starts to move lower, it's going to give a bid in the dollar versus the Canadian as well. So let's keep an eye on that dollar CAD. Any other, Dale, do you have any opinions here before we have, oh shoot, the release is coming out right now. Sorry guys, I needed to pull up the data flash. What do we got? A little weaker than expected on core. So a little weaker than expected. Let me grab that.
No, I don't think so. It's coming in line roughly as expected on the headline. Core
CPI
slightly higher on the
6.1%, expected 6.7%.
CPI 7.6 versus 7.6.
Oh, maybe. Oh, I was looking at
year on year.
looking at the core right there.
Yeah.
All right, got it. Yeah, in line. Well, let's see if we can hold this.
Building permits
support.
negative. Minus
All the
1.3 versus.
are higher.
What's
So
that?
core common is higher, 5.5 versus 4.6 prior. Median is 5.0 versus 4.9. The only one is softer is the trim, which is 5.4 versus 5.5 prior. So I'd say that was on the hotter side, inflation.
All right. Well, and you know what? And the Canadian is responding now. What also could be developing here, and this is one other thing. Before Dale, we let you go with your interview. Watch the support right here, just in case that is flagging. It's an actual flag pattern, which that means we make a brief new low and then we ratchet right back up again. So before you get all twisted in knots, getting on the short side here, just keep in mind we might find some support just a little bit lower than where we're at. I want to thank everybody for being here this morning. Like I said, Steve, welcome back. It's nice to have you back. I know it probably doesn't feel good to be back.
No, it's fine. It's fine. I mean, balance is needed.
Wait. You stopped swimming in the Aegean Sea and you came off the beach and it's okay to get back in your office? What's wrong with you, man?
Nothing. I just I have to remind you that I'm leaving again in 3 days. So.
oh yeah. All right. That's true. Good point.
So
all right.
3 days is
then,
okay.
Do you rejoin the company after Labor Day, Steve?
Sorry, what?
You rejoin the company after Labor Day?
They don't have Labor Day.
We do 1st of May, actually.
Oh, well, I mean, they don't celebrate our Labor Day, Dale.
Oh,
no,
okay.
we don't celebrate your Labor Day.
In September, are you rejoining the company?
No, this time I'm going to be away only for 3 days, mate.
I'm kidding you.
An extended weekend.
And then we're missing Stelios. He's out on the beach somewhere. But we do have Ryan and Kman back. So make sure you guys and gals join in the Flow Show. Thanks for supporting us here at the free F.A.C.E experience. And Dale, thanks for being our host every day. You guys have a great trading day. Good luck today. And watch, today is a perfect setup for Turnaround Tuesday, by the way. It is Tuesday and the markets have been on fire the last few weeks. Today would be a nice setup for a reversal. I'm playing it. I'm short. So there we go. All right.
Good hunting, Blake. Thank you, team. Welcome back to F.A.C.E, I believe, Dario. How are you?
Oh yeah, I'm good, thanks. I've just come back from holiday myself, so trying to adjust.
Yeah. Okay, yeah, well, it's nice to have you. That's for sure. And how long has it been since you and I had a conversation?
I think it was probably 3 months ago.
Oh, okay.
So we were just kind of starting out at a kind of European hiking cycle. So
all right.
Yeah, it was about 3 months ago. The ECB was getting people prepared for its first hike, and the Bank of England was kind of panicking a bit, and we had a lot of pressure coming from the strong dollar.
Okay, so why don't we start there? So technically, the euro got turned back from prior lows, the 20-year lows here around 103.40 as well, and we got rejected, couldn't close above it. In your view, do you think that the euro could dig in, put in a higher low, and then come off and then rally again?
Yeah, I think that we've kind of stabilized a bit here. I think the big change is obviously to the dollar. I would say that investors. I mean, I talk to a lot of institutional investors. They've been very focused on US recession risk over the last 2 or 3 months, since we last talked. And this idea that we're close to peak inflation. I mean, that's obviously been the big theme of the last few weeks. And the idea that the pressure on the Fed to continue hiking at this kind of insane pace that we've been at in the first half of the year is beginning to diminish a little bit now. So that's giving us a kind of depreciation in the dollar, and it's helping all of these other central banks. And one of the things that I spoke about last time with you is that a lot of the pressure that those other central banks have been facing on the inflation side has been largely imported. We're not by any means having a sort of boom in Europe. It's been very different. We've been having a kind of stagflationary shock that's been coming from Ukraine, but there's been no boom here. And so all of the inflation has been imported. And those other central banks were just kind of following the Fed higher, because if they didn't, they were just importing more and more inflation.
Dario, do you remember where the G20 met and there was no fanfare over it, I think a month or so ago, right near the Euro bottom in July? So and the Euro never moved lower. There's some conjecture by guys like Luke Roman that the G20 cut some kind of deal that they're being quiet about to, attempt to reverse dollar strength and support euro, support yen. Do you think there was any grand bargain struck by the central banks? Have you noticed anything that would tell you that?
No, I mean, I don't really buy that. I mean,
Okay.
I spent about half of my career in policy making.
Okay.
They just don't. There isn't
right.
that. You just don't get that. I mean, I used to work at the UK Treasury,
Right.
Some work for the Bank of England.
You're a Gordon Brown's guy.
Yeah, I'm exactly.
So Dario, what should we do?
Don't get those. You don't get those levels of agreement internationally. It's just almost impossible. And I remember, very simple communiques that the G7 and the G20 wanted to put out in the early 2000s, and they just required endless redrafting and kind of nitpicking over particular words. The idea that these guys could get together and agree some kind of grand bargain for exchange rates, I just think is a bit fanciful at this point.
All right, so the days of a Plaza Accord is no longer possible because we don't have the same type of central bank cooperation.
Exactly. We're just a long way from that.
Allies aren't really allies anymore.
Exactly.
Everyone's looking out for their own ass.
Exactly. And you've seen this in the kind of race that we were in the first half of the year, where all of these central banks just seem to be in a race to crush their economy through seeing who could raise interest rates the fastest.
Do you think we're in a recession, Dario? I mean, when we were exchanging a few ideas on Twitter, you talked about the inversion.
No, I think that we have a kind of fake recession, and even at the start of the year, I was writing about this summer recession scare. And so the fact that it's here and people are panicking about recession, I'm trying not to overreact to that, having been talking about it for 6-7 months. If anything, it's taken longer to materialize than I thought. I thought that, I think this is a kind of fake recession because it's coming from these kind of lingering distortions from COVID. It's coming from the situation in Ukraine. You basically have this kind of bullwhip effect in global manufacturing. And, for decades, economists have built these leading indicators of the global economy based on manufacturing. And the fact is that manufacturing is giving us a really bad steer right now because we're in this kind of bizarro world where everyone was sitting at home buying stuff off the internet, and they weren't going on holiday, they weren't going to restaurants, they weren't going to cafes, they weren't commuting. And we're kind of shifted back to a different world where we've gone back to a kind of pre-COVID normality, and so you've got these massive shifts in spending in the economy, and manufacturing is getting absolutely hammered by that. And of course, all of these manufacturers and retailers and wholesalers were building up these inventories because they thought that this kind of booming economy of 2021 was going to continue indefinitely. So you've had this kind of bullwhip effect in inventories just at the point where demand is flipping the other way. So I think all of that is sort of fake. And I think that we have a massive squeeze on consumers that's coming from just very high levels of inflation, because we're all spending more on energy and food, particularly in Europe, where this is the biggest problem.
Isn't it worrisome that a lot of this spending is showing up in consumer credit, on revolving credit cards? I think that we're extremely high readings, and I know you've seen this movie before. What does that lead to?
I think it's a sign that consumers are just under enormous pressure. And, everyone has been focused on this accumulation of savings during the pandemic. The fact that we weren't doing all those things, we saved all this money. And so there's a lot of liquid assets on balance sheets, but those are very heavily concentrated, among wealthier people. And low income households did not accumulate those kinds of savings, and now they're being hit by these very high prices. So in order to protect their living standard, they're suddenly taking out credit card debt, and that is worrying. And obviously that can't continue indefinitely. But I think I still think a big part of the inflation that we've had is likely to be transitory. I think the inflation is going to come down quite sharply over the next 6 months. And so those pressures will begin to ease. And I think the really important thing, the reason that you don't get a proper recession here, is that there are just massive labor shortages, everywhere, but particularly in the US, particularly in the UK, countries that have seen their labor force shrink over the past 2.5 years. And so, because you have those labor shortages, you're not going to see companies firing workers. And that's the bit, if you want to, people can debate.
Then that's going to force a real, what people are already saying is a policy error of backward looking things by the Fed, because if they're focused on the labor market and they want to break the labor market, and it's going to be persistently tough to do, it means they're going to continue to tighten while other conditions are deteriorating.
Well, I think that's right, but I think the recession that we have now is fake. So I'm not too worried about growth. I think housing is the bit we need to watch, because housing is coming from actual demand destruction. The genuine demand destruction this year has come from monetary tightening, and so that's where we're seeing the effects of what central banks have been doing, and that's happening in housing markets. But I think because there are these labor shortages, we're not going to see companies laying off workers, and to me, that's the definition of a recession. A recession is when you get a contraction in employment. That's really the only definition that makes sense. And the reason for that is that when companies start to fire workers, then you get these kind of nasty spillover and feedback loops. That's when consumers then start to cut spending again. That feeds back into the corporate sector because revenues go down, and that leads to more job losses. And so when you're in that kind of dynamic, that's a really nasty feedback loop, and that creates massive uncertainty about how bad the recession is going to be and how long the recession is going to last. And that's the kind of dynamic that investors absolutely hate, because that's just horrible for asset returns. I just don't see that dynamic kicking in. I think if anything, the fact that inflation should come down and wages are now growing quite strong because of this labor shortage, I think we'll actually see real incomes rebound next year. And people will be quite surprised about how quickly the economy recovers. And, you can call this a recession or not. If we're debating the technicalities of a recession, then I think that's probably positive at this point, because, what a proper recession is when you see it. There's no debate. You don't have to debate whether it's technically a recession or not. And I just don't see those sorts of dynamics kicking in. But the big risk here is obviously central banks, because we've been on this course of very aggressive tightening. If we're raising interest rates 50, 75 basis points every month, then clearly we're going to get to a point where there is genuine demand destruction, where there is genuine risk of recession. And I think the inversion in bond markets is really telling central bankers that they need to be careful. People look at inversion and they say, well, inversion tells you that a recession is coming. Well, it sort of does. It sort of tells you that a recession is possible in the next 18 months. But you also get soft landings when the curve is inverted. So what the curve inversion is really doing is it's telling you that the more central banks tighten now, the more they're going to have to cut interest rates next year or the year after. And so it's really telling central banks that they need to be careful. And actually, if you look at the inversions in the past that didn't lead to recession, The reason they didn't lead to recession is because central banks actually responded to what the bond market was saying. So the classic example is 1995, where you had a recession scare. You actually had a contraction in payrolls that was later revised away. So there's a bit of good luck there. But the Fed took notice of that, and it stopped tightening, and it actually eased a little bit. 2019, same dynamic again. I think we basically had a soft landing in 2019 before COVID kicked in. And again, Powell was paying a lot of attention to what the bond market was telling him. Okay. So when you have an inversion and central banks react to that inversion, then that's your best prospect of a soft landing. The problem that we have right now is that the inflation data is not yet allowing central banks, particularly the Fed, the opportunity to actually respond to what the bond market is saying, because they have this kind of nightmare scenario of the 1970s, which is just haunting them. And it's hanging over all of their actions right now.
Okay, so if you're forecasting inflation falling fairly dramatically over the next 6 months, does this make you constructive in the bond market? You want to be long bonds and short things like gold and silver?
I think tactically, I think it means that the kind of terminal rate in yields is likely to come down. I wouldn't say I'm bullish on bonds, because I think that we are moving into a world where inflation is going to be 100 and 150 basis points higher than we've been used to over the 2010s. So I think there is this kind of secular reflation story that is underpinning all of this, and that kind of labor shortage that we have now, I think, is going to turn into a kind of secular theme with things like deglobalization and even demographics to some degree. So I think we're in a secular reflationary environment. I think real returns in bonds over the next 5 years are going to be horrible. I think we're going to get more episodes of transitory inflation where inflation spikes very high. Part of that,
like it did in the 70s, it would abate and then reemerge.
Yeah, I think it's more like the 40s and the 50s. So in the 70s, you had.
Oh, well, I know, but I was, I know a lot of people think I was around in the 40s, but I wasn't yet.
So no, but I mean, I've done a lot of work on the 40s
Okay.
and 50s, and I think it's the close historical parallel, because inflation didn't spiral. So in the 1970s, you had these big, nasty wage price spirals. So you had big spikes in inflation, but then inflation.
The oil embargo.
Yeah, and then inflation settled at a higher level. So you had 3 recessions in the 1970s, and each recession kind of took some of the wind out of inflation, but inflation settled at a higher level after the recession. And so it trended higher during that period, and yields trended higher during that period. And so I don't see inflation trending higher in the same way, but I think it will be persistently higher. And I just think we'll get these periods where it becomes very high and then reverts lower again. And so central banks won't always react to those. So you're going to get more transitory inflation stories. And that means that there'll be this kind of financial repression where, real returns in bonds will get absolutely hammered. And part of that is climate change. So, not just the disruption that comes from climate change itself, but also this transition to intermittent energy sources, which means that we're going to get a lot more volatility in commodity prices than we've been used to for a very long time. And so, I'm not optimistic on bonds. I think that there is a kind of tactical play short term.
What do you like, Dario?
I think so. I talk about the 2020s as the tangible 20s. I think the basic investment world is changing. I think we've had this period of very long perma zero interest rates, endless QE, everything got re-rated. So you didn't have to be particularly sophisticated as an investor. You just put your money into US tech and watched it go to the moon. And I think we're in a world where the basic challenge of policy is changing. So instead of an inflation rate that always threatens to fall below 2%, I think we're in a world where inflation will always be threatening to break above 3%. And so we're not going back to zero interest rates. We're not going to have QE. We're not going to have this continuous re-rating in asset prices. And so what investors want is exposure to the real economy. They need to figure out what are the growth stories for the 2020s, looking beyond all this noise, all of these distortions that we have in the economy right now. I don't think the next 6 months is going to clear up any of these distortions. We're not going to have this kind of head clutching recession that gives this moment of clarity. But I think you need to look beyond that, and you need to think, well, what is the next 5-10 years going to look like? And I think it's commodities. I think it's value stocks. I think it's, materials. It's about, almost a real economic revival, and, actually bringing financial markets and the real economy together again, because they've been completely disconnected over the past 20 years. And I people look at this and they see this kind of very bearish world for investors, but I don't think it's bearish. I think it's just different. And I think there will be investment opportunities in that sort of world, but it's going to be very different to what investors have been used to over the past 15 years.
Is Christopher Granville Joe Granville's son?
I don't think so.
Okay.
He's a former diplomat, so he's a kind of expert on Russia, and there's this YouTube clip about actually getting picked by name by Putin, who answered his question and named him. So he's kind of famous for that. But yeah, I don't think.
Okay.
I don't
Does
think.
he think? I notice Russia, the Forever War. Is that the take of the company that you're with?
Yeah, well, it's part of this. It's part of this narrative. So this is a world where something has fundamentally changed over the past 3 years, and a big part of that is the situation in Ukraine. It's the weaponization of the dollar. It's deglobalization. It's the shrinking of global supply chains. It's the reorientation of the world into these kind of trading blocks. It's a very different world. And if globalization brought us kind of endless disinflation, a collapse in worker power, supersized, corporate profits, and low interest rates, then it's the reversal of that. It's a very different type of environment. So it all feeds in to this sort of tangible 20s story that I think is the big theme coming out of all of this chaos of the last couple of years.
Okay, and the relationship after Pelosi's trip to Taiwan? What's T.S. Lombard thinking about that? Is it going to escalate or just simmer?
It's simmering, and it's this is a sort of theme that had started well before COVID, well before Ukraine.
Started with the trade war under President Trump.
The trade war, but it was a very popular trade war in the sense that it wasn't just about Trump. It was about U.S. politics, and so this is
it's the only thing that Democrats and Republicans agree on is their hawkishness towards China.
Exactly. That's why
I don't get it.
That's why it seems, almost inevitable at this point. And so it's about that
war seems inevitable.
It's not about hot war. It's more sort of cold war. And it's about a changing in the way that we trade, the kind of untangling of US and China. It's about, strategic economic interests. It's about securing, certain raw materials, securing semiconductors, reducing those interdependencies. It's an unraveling of the kind of neoliberalism of the last 30 years. And to me, that's what the super cycle is, this kind of long 30, 40 year super cycle that we've had in macro, about interest rates, inflation, the economy. It's all been about the balance of power between labor and capital. And, we had, after the 1980s, because of the high inflation of the 1970s, we basically spent 40 years destroying the bargaining power of workers, through tech, through globalization. And that's the thing that's beginning to change. That super cycle is beginning to turn. And I think the implications for investors are absolutely profound. This is a regime change.
How does crypto fit into this new super cycle?
Well, I mean, it in a sense, it doesn't. I think that crypto was kind of the digital tulips, wasn't it, of the last 2 years? And again, I'm a big fan of history. And if you look back at the tulip mania, one of the things that people don't know about that often is that it happened during a pandemic. We had this particularly bad outbreak of the plague. So you had European trade was basically in a sort of lockdown. You had a bunch of merchants that were sitting around in taverns because they had nothing to do. And they'd inherited cash. So they had a lot of excess liquidity from people that died because of the plague. And they were bidding up the price of tulips. And so we've kind of gone through this sort of
interesting.
repeat over the past
Yeah.
2 years with this kind of tulip mania, but happening in the kind
Only
of,
they're digital this time.
yeah,
Digital.
Well, I wrote a note at the peak saying it was called digital tulips, and it was looking at the kind of lesson from history. And I guess as we came out of the pandemic and things went back to normal, and central banks suddenly started to raise interest rates, it killed all of those bubbles. And I guess one of the telling things is that Bitcoin hasn't really come back the way that some of the kind of meme stocks have over the past few weeks. That something has changed here, I think.
Well, maybe the similarity is flowers die.
Yeah.
Even if they're tulip bit up. So Dario, really was nice connecting up with you and getting your macro feel for what's going on, and sharing that we're in a new paradigm, and it takes people time to adjust to it, and it's early in it, so you have time to adjust. And appreciate you sharing your views. Best way for people to follow your work, would it be on Twitter at your handle, which is your name, at Dario Perkins?
Yeah, so I'm on Twitter. I use Twitter quite a lot. I write a blog. Not super often, because obviously we write kind of subscription research, but I write a free blog probably once a month, which is quite popular. So you can find me on there. But Twitter is probably the best place to start.
Okay, so there's Dario's Twitter, and this would be his blogs right here. Blogs at TS Lombard. To read his musings of Gordon Brown's guy. Dario
I wouldn't go that far.
I would. I didn't say boyfriend. Okay,
no, I meant
right-hand man for Gordon Brown. Dario Perkins.
I used to run Gordon Brown's global economy forecast in the early 2000s, but then I also worked for his opposition. So I worked for the left and the right, because it was
if I asked Danny Blanchflower about you, what would he say?
Yeah, well, he seems to like me. We
good. All
right, get on quite well. So
all right. Well, I appreciate your giving spirit today, Dario, and
taking
time out of your day to edify our community.
All right, take care.
All right, Dario Perkins, everybody. Good luck the rest of the trading session, and you could join the dream team in 18 minutes on the Morning Edge. Remember, don't just count your narratives, count your blessings, and we'll see everyone tomorrow. Adios, everyone. Have a great day. Win, lose, or draw, you're in the game. Some people can't even get into the game. They have no chips. Protect yours. Adios.